Hey, hello, folks. Welcome to Pro Trader Strategies. My name's Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you roll, and that's going to be talking about the economic data, how that impacts the markets with a little market analysis, maybe sprinkle in a little geopolitical fodder to round that all off, and then talk about some strategies we could implement into a portfolio based on those assumptions we come up with in the market analysis. All right, so without further ado, let's get on with everything that's been going on. Not really a whole lot of economic data today, but we did get the Great Britain CBI industrial order expectations coming in lighter than expected at 8, expected to be 13. Not a huge surprise there. We saw last week, right? The forward-looking PMI numbers, flash estimates coming out of Europe, and those were all coming in pretty much below expectations and below 50, which showed contraction in the economy there. So when we're seeing order expectations lower, well, that's a product of the forward-looking PMI. So not a major surprise there. German business climate coming in lower than expected at 88.6 as well. So that's about it for economic data today. This week, though, we do get Richmond Fed continuing with those manufacturing numbers to see if those come in lighter than expected, like we saw with the Philly Fed. We also got new home sales. That's probably going to be a little bit light. Actually, that one could be a wild card, to be honest, because then on Wednesday, we have the FOMC. Is that something that is in the back of folks' minds, that interest rates are rising, so that if they were considering buying a home, they are really trying to get that done before interest rates rise? Because we've talked about this time and time again. If interest rates rise, you can afford less of a home because of the budgeting for that home. Then we also on Wednesday get the FOMC meeting. They're probably going to raise it by 75 basis points. Now, that's going from 1.75 to 2.5. Now, if they raise, some folks out on the street are saying that they might raise 1 full percentage point or 100 basis points. That would bring the Fed funds rate to 2.75. A lot of folks are saying that Fed funds are going to 4%. So we'd be, well, at least halfway there with this raise here. I think it'd be way too aggressive to raise at 1 percentage point at a time. It's increasing borrowing costs for corporations. That's going to slow them down. It's increasing costs for folks like you and I to buy a house. It's more difficult to buy a house as interest rates rise with all of the things we have to go through in order to get that home loan. And then later on in the week, we get some other economic data, but for the most part, we get Friday, we get our consumer price index and personal consumption expenditures, Chicago PMI also. So Friday is probably setting up to be the best day for economic data, but the busiest day of the week is probably going to be Wednesday as folks are getting ready for the FOMC. So while we're not getting a lot of economic data this week, the FOMC is really going to be causing this market to move back and forth. Richmond Fed manufacturing coming in really low could start increasing the probabilities of a 75. We see the slowing down before this meeting. Now, keep in mind that FOMC on Wednesday, those folks, the Fed gets the blue book, which is very similar to the beige book that I've talked about time and time again. That's why it's really important to look at that number. It will have fresh data added into it. As a matter of fact, they probably even will be getting a glimpse at the Richmond manufacturing. Sorry, they're on Wednesday. So they'll probably get the durable goods numbers and pending homes, wholesale inventories, crude oil. They'll get all of that a little bit early before they make their announcements there. So that could influence their decision-making in that. All right, so let's get on with the markets. We've got crude oil making a little bit of a move to the upside. Well, we've had 2 days of indecision. Now, I'm hoping that this is going to be allowing for a continuation to the downside. Anytime you get counter-opposing dojis, that's what it usually looks like. Now, today's not out of the woods at this point in time, but we do want to see some weakness. I mean, folks are already celebrating on social media that crude oil prices have gone down, or actually that the price at the pump has gone down. So folks are starting to really feel the pain at the pump if it goes down 50 cents, and people are, celebrating in the streets almost. All right, bonds have continued to make this march to the upside, showing that the Fed is going to go too far, too fast, meaning raising interest rates. So the back end of the curve is saying, well, yeah, I don't care how far you go, you're going to overdo it. And we're going to have to cut rates because it looks like we are slowing down here. Gold, as it tested this tweezer bottom, created a tweezer bottom here, finding a nice base here. Market is moving to the upside, but these flight to safety sitting on cash that is very liquid just doesn't seem to be too sexy. I thought it was going to get a little bit of that move with Bitcoin to the upside here recently. It looked like finally that the newer generation was parking money in something like Bitcoin as a safe store of value. And we've gotten that move to the upside. Are folks starting to cover because we're getting the equities to make a move to the upside? Let's just get past the VIX here. Market has made a nice move. As soon as we blew through that 50-day simple moving average, we were off to the upside, broke out of that little trend channel that we created quite a while back there. So breaking out of that and really creating this nice little bottom here. So I've talked about this time and time again. Grinding it out, not a V-shaped recovery, but something to note here. We've had a nice long run to the downside, creating lower lows and lower highs. Now we've broken that, creating a little bit of a higher high here, and market trying to grind this out to the upside. I don't think that the bottom is necessarily out here. I think we will have another retest. I don't think it's going to be of maybe the bottom that we saw, but I do think that the market is going to flush to the downside one last time, maybe create some tweezer bottoms of its own. But the market making these moves just really isn't pricing in, as far as I'm concerned, the recessionary aspect that is looming here. Dow Jones Industrial Average, not really super surprised that Dow Jones is the one that's really driving to the upside, as folks are finally putting money in the blue chips, because the economy is not terrible right now, folks. It's just very fragile. And one of the major aspects of this is you're going to hear a lot of people talking all day about, and I've already started to see this is probably going to be what folks are talking about in the next couple of weeks, is crude oil, and the fact that the United States, crude oil prices continue to rise. All right, I get that. The administration is trying to blame it on Russia and the Ukraine. All right, I get that too. Supply chain issues over in Europe. That's not going to affect us necessarily. We have more oil than just about anybody. The issue is, well, we are producing almost 12 million barrels a day, which is historically very high for the United States. But the problem is we are looking at gas prices at the pump based on the crude oil futures. And why are the futures so high if the United States is producing more oil than it ever has in history? Well, the fact is, it has to do with future expectations, okay? We know what the supply and demand curve looks like right now. Well, the supply, though, has completely flatlined, right? We cannot produce any more than, let's say, 12 million barrels a day, or 12 million barrels a day. So if that mark doesn't move and demand continues to increase, that is going to drive prices higher. So right now, the market knows that the current administration is not going to open up any more permits, is not going to allow that 12 million barrels to go to 13 million barrels or 14 million barrels a day. So without any future expectations of more supply and constantly increasing demand, well, that's going to make the prices move higher. And right now, the futures know there is no more future expectations of increasing the supply of oil. That's driving this price higher. It's a future, just like anything else. And this isn't today's price. It's based on future expectations. So that's driving it higher as well. So crude oil is going to continue to try to grind higher unless we have a major economic event where the economy is slowed down to a snail's pace. Well, that lack of demand will drive price down, but there's supply that we could increase, and that would ease some of these pricing tensions that we're seeing here in crude oil. And that is a major thing to tackle right now, because crude oil, gasoline is driving inflation everywhere, despite the fact that they're talking about fertilizers and all of these other things. Are just really trying to point the finger in different directions to not keep your eye on the ball, to try and take your eye off the shifty hand, if you will, as they're playing the shell game. All right, so E-mini S&Ps are grinding a little bit higher. Dow Jones definitely making the moves to the upside, but it looks like we found a little bit of a bottom. I think that there will be one last press to the downside to try and flush out any of the weaker hands here, and then resume a little bit of that rally. So if we look at the breakdown overnight, pretty much long coming into today, but I think you're going to mostly see consolidation happen for today and tomorrow heading into the FOMC meeting. Folks are going to be hedging up a position as well, or hedging up their positions as well as what you should be doing, folks. Lowering overall cost basis, reducing some of that risk in the portfolio, and getting ready for maybe 100 basis point move, which would shock the markets a little bit, I believe. All right, that's all I got for you, folks. If you can't take that, take it easy.